There's a number that doesn't get discussed enough in conversations about investing. Not the market's return, not a fund's return, the investor's return. The return actually earned by the people holding the fund, as opposed to the return the fund itself generated. And the gap between those two numbers, documented across decades of data, across fund categories and geographies, is significant. Investors in the same funds consistently earn less than the funds themselves return. The gap has a name. It's called the behavior gap, and it emerges from a specific pattern. Investors don't hold funds passively through the full return period. They enter and exit based on how they feel about the market at various points along the way. They enter after periods of strong performance, after the fund has already risen significantly, after the conditions that produced the gain are already reflected in the price. They exit after periods of poor performance, after the fund has already declined, after the pain of holding through the drawdown has become too significant to sustain. And by entering late and exiting early, by buying high and selling low, they capture a fraction of the return that a patient, undisturbed holder of the same fund would have earned. The data on this is consistent and striking. Research tracking investor returns versus fund returns over long periods shows the average investor earning meaningfully less than the average fund. Not because the funds were bad, because the investor behavior inside the funds was generating returns that diverged from the fund's actual performance. The investor was using the same vehicle, taking more or less the same market exposure. But through the timing of their entries and exits, through the behavioral choices they made about when to be in and when to be out, they were converting a reasonable long-term return into a worse one. Not through fraud, not through bad fund selection, through the timing of their own decisions. The behavior gap compounds over time. A 1% annual difference between fund return and investor return doesn't sound significant. Over 20 years, it produces a meaningfully different ending position. Because the investor who earned less per year had a smaller compounding base, and a smaller compounding base generates smaller returns, which compounds into a smaller base, which generates smaller returns. The gap between fund return and investor return isn't additive, it's multiplicative. It compounds in the same direction as the returns themselves, just against the investor. The market return is what's available. The investor return is what gets captured. And the gap between them, the behavior gap, is the cost of the emotional relationship most investors have with markets. Not the cost of bad fund selection, not the cost of high fees, not the cost of bad luck. The cost of entering and exiting at the wrong points, driven by how the market felt rather than by the underlying investment logic, paid consistently, year after year, compounding against the investor for the entire holding period. The behavioral errors that produce the gap aren't random. They follow predictable patterns. They occur at predictable times. They're driven by predictable psychological mechanisms that have been documented across decades of behavioral finance research. Understanding the specific errors, not as personal failures, but as predictable behavioral patterns, is the beginning of building a framework that reduces them. The first error is loss aversion. Losses feel approximately twice as painful as equivalent gains feel pleasurable. This isn't a weakness of character. It's a feature of human psychology, one that likely served an evolutionary purpose in environments where losses were genuinely dangerous. But in an investing context, where temporary price declines are a normal feature of the journey rather than a permanent threat, loss aversion produces a specific error. It makes holding through drawdowns disproportionately painful. A portfolio down 20%
feels worse than its actual financial impact. The psychological weight of the loss exceeds the rational assessment of it, which produces the impulse to sell, to stop the pain at exactly the wrong moment, when the position is most likely to recover, when the entry point for new investors is most attractive. The second error is recency bias. Investors overweight recent performance when projecting future performance. After a long bull market, after several years of strong returns, investors extrapolate that trajectory forward. The market has been going up. It will keep going up. And they increase exposure, buy more, take on more risk, precisely as the market reaches a point where the expected forward return is lower than it has been. After a significant decline, after a bear market has been painful and the news is uniformly negative, investors extrapolate that trajectory forward. The market has been going down. It will keep going down. And they reduce exposure, sell, move to safety, precisely as the market reaches a point where the expected forward return is higher than it has been. Recency bias inverts the rational relationship between price and attractiveness. It makes things feel most attractive when they're most expensive, and least attractive when they're most compellingly valued. The third error is overconfidence. Investors consistently overestimate their ability to predict market direction, identify winning securities, and time their entries and exits successfully. The evidence on this is consistent. Most investors who believe they have an edge don't generate the returns their confidence implies they should. Overconfidence produces excessive trading, more portfolio turnover than the strategy requires, more taxable events, more opportunities for timing errors, more costs. And the additional activity, the expression of the overconfidence, produces lower returns than the passive baseline that requires no prediction and no timing. These three errors, loss aversion, recency bias, overconfidence, interact with each other. A declining market triggers loss aversion, producing the impulse to sell. Recency bias reinforces it. The declining trend feels like it will continue. And overconfidence provides the justification. The investor believes they can identify the right moment to re-enter after the decline has run its course. The combination produces the classic behavioral pattern, selling into weakness and buying back into strength, which is the precise sequence that generates the behavior gap, converting the market's long-term return into a materially lower investor return.
If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video. Subscribe. More clarity is coming. Behavioral errors in investing are commonly framed as personal failures, a discipline problem, an emotional weakness, something to be overcome through willpower and better decision-making. That framing is wrong, and it matters that it's wrong, because misidentifying the source of the error produces the wrong solution. Behavioral errors in investing aren't failures of character. They're the predictable output of cognitive systems that evolved for a different environment than the one investors are operating in. Human cognition evolved in an environment where threats were immediate and physical, where a rustling in the grass required an instant, instinctive response, not careful deliberation. The cognitive systems that made that response possible, fast, emotionally driven, pattern recognizing, loss averse, were adaptive in that environment. In an investing context, where the threats are abstract, where the appropriate response to a decline is often to do nothing or to buy more,
where the time horizon is decades rather than seconds, those same cognitive systems produce systematically wrong responses. Not because the investor is failing, because the cognitive hardware was built for a different operating environment. The financial ecosystem around investors is designed to exploit this mismatch. Financial media profits from engagement. Engagement is driven by anxiety. Anxiety is produced by urgency. Urgency is manufactured through the framing of every market movement as something that requires an immediate response. Breaking news, market alert, what you should do now. Each of these is designed to activate exactly the cognitive systems that produce the worst investment decisions, the fast, emotionally driven, loss-averse responses that sell into weakness and chase strength. The media doesn't profit from long-term investor returns. It profits from the attention generated by the anxiety those returns produce when they're framed as daily events requiring constant monitoring and response. Brokerage platforms are similarly designed. The tools available to most investors, real-time quotes, news feeds, analyst ratings, portfolio alerts, are all instruments that increase the frequency of engagement with the portfolio. And increased engagement increases the opportunity for behavioral error. The investor who checks their portfolio daily has more opportunities to react to short-term movements that are irrelevant to their long-term outcome. More opportunities to see a decline and feel the loss aversion. More opportunities to see strength and feel the recency bias pulling them in. More opportunities to make a decision that the long-term investor they intend to be wouldn't make. Understanding the structural source of behavioral errors changes what the solution looks like. The solution isn't more willpower. It isn't trying harder to be rational in the moment when the market is declining. The solution is structural. It's changing the environment in which the investment decisions get made, reducing the frequency of engagement, removing the triggers that activate the wrong systems, building rules that govern behavior before the conditions arise that would compromise it. The behavioral errors aren't personal, but the framework to reduce them has to be personal, built specifically for the investor who understands how their own cognition interacts with the environment the financial ecosystem has created around them.
A behavioral framework for investing isn't about eliminating emotion. Emotion can't be eliminated, and trying to suppress it usually produces the opposite of the intended effect, the suppressed response finding a different expression at a different moment. The framework is about something more structural, removing the conditions under which emotion produces the most damaging decisions. The first structural element is reduced monitoring frequency. The investor who checks their portfolio daily has 250 opportunities per year to react to market movements. The investor who checks quarterly has 4. The reduction in monitoring frequency is not a reduction in information. The market's long-term trajectory isn't meaningfully changed by what happens in any given week. The reduction is in the number of opportunities to make an emotionally driven decision that the long-term investment rationale doesn't support. Fewer touch points means fewer activation events for the cognitive systems that produce loss aversion and recency bias. It's not about being uninformed. It's about not giving yourself 250 chances per year to make the same expensive mistake. The second structural element is pre-committed rules. Rules established before the conditions arise that would require using them. Not selling in a decline of more than X% unless specific fundamental conditions change. Rebalancing when allocation drifts beyond Y%, regardless of market direction. Continuing contributions regardless of market level,
not increasing them when markets are performing well and not reducing them when they're not. These rules don't require emotional override in the moment. They require a decision made in advance, in calm conditions, that governs behavior when conditions are no longer calm. The behavioral framework operates before the emotion arrives, not during it. The third structural element is written investment rationale, a clear, specific, written articulation of why each position is held, what the expected long-term case is, what the basis for that expectation is, what would actually constitute a reason to change the position. During a market decline, when the emotion is present, when the cognitive systems are activated, when the impulse to act is strong, the written rationale provides a reference point created in calm conditions, not an argument against selling, a check against the specific question. Has anything changed about the fundamental case that justified holding this position? If no, the written rationale holds. The position holds. The behavioral error doesn't occur. None of this is complicated. The behavioral framework isn't sophisticated. It doesn't require advanced financial knowledge or exceptional discipline. It requires three things: checking the portfolio less often, having pre-committed rules that govern behavior during specific conditions, writing down why each position is held, and consulting that rationale before any significant decision is made. These structural elements don't produce better market predictions. They don't generate alpha. They don't make the investor smarter than the market. They reduce the frequency of the specific behavioral errors that cost most investors the gap between market returns and the returns they actually capture. The market return is available. The behavioral framework is what determines how much of it you actually get. If this shifted something for you, subscribe. Like this if it clarified something.